At first glance, a trading screen looks like chaos. The flashing red and green numbers move so fast, the system feels like a high-stakes casino. Strip away the screens, and the reality is far more practical. Trading is a marketplace. Participants buy and sell financial assets for one reason: to profit from a change in price. Imagine buying a phone for $20,000. Later, a buyer pays $25,000, leaving you a $5,000 profit. Trading works the exact same way, replacing the phone with a stock or contract. Successful traders aren't looking for items to own forever. They are looking for movement. They prioritize the shift in price over the ownership of the asset. Because ownership is secondary, the real skill lies in analyzing the probability of where that price is headed next. Price direction isn't random. It is dictated by the constant imbalance between buying and selling pressure. If 10 people are fighting to buy a single chair, the seller can demand more money. The price increases. If that scenario flips, one buyer surrounded by 10 chairs, the sellers must compete with each other to get a deal. The price drops. This pressure is fueled by real-world data, breaking news, economic reports, and the human emotions of fear and greed. Every tick on a chart is a visual record of this tug-of-war. Think of the market as a shopping mall. The instruments are the different types of shops inside it. In the stock market, you buy a slice of a company. As the company earns more, your slice becomes more valuable. In Forex, you trade national currencies against each other based on global economic strength. In crypto, you trade digital assets, where value is driven by rapid shifts in public belief and sentiment. And in derivatives, like futures and options, you are trading agreements on future prices, similar to paying a small fee today to reserve a movie ticket for next week. The instrument changes, but the goal remains the same: capturing the difference between your entry price and your exit price. How a trader navigates these markets depends on two variables: volatility and liquidity. Volatility is the speed and the scale of price movement. A low volatility market moves like a calm lake. High volatility is a stormy sea. It provides more opportunities for profit, but significantly higher risk. Liquidity is the ease of buying or selling an asset without forcing a major jump in its price. Cash is liquid because you can use it instantly. A house is illiquid because finding a buyer takes months of effort. Understanding these two forces is what prevents a trader from getting stuck in a position they can't exit. Finally, you have to look at who is in the room with you. The market is a hierarchy. This chart shows the participants, from central banks and governments to individual people at their desks. Retail traders are the small fish in this ecosystem. The big whales, the banks and institutions, provide the heavy volume that moves the market. Success for a small fish means learning to identify and ride the currents those whales create. Those flashing numbers on a trading screen are the visual footprint of this global tug-of-war. When you ignore the mechanics of supply and demand, the volatility of the market becomes a trap. Trading is a skill built on 3 pillars: understanding people, prices, and probability. If you are just starting, pick one market and observe it. Focus on how it reacts to news and volume. The path forward is to master the mechanics of movement before you ever